This video explains the adjusting process, adjusting the deferral of revenue and deferral of expenses. Imagine the business in operation in the current period. Sales are being earned, expenses and liabilities being incurred, assets being used up. Accounting is being done throughout the month or the accounting period. Trial balance is assembled. At this point, the trial balance is an unadjusted trial balance because there are some transactions that still needs to be recorded. At the end of the period, the company needs to record additional entries called adjusting entries. The question is why? What are these entries and why wasn't it recorded before? Let's say in an earlier period, the company may have received cash payment for products from the customer and products needs to be delivered or services needs to be performed. At that point, the company would record cash received and unearned revenue because revenue was not earned at that point and is deferred to being earned in the future. Unearned revenue is a liability because cash was received in hand from the customer, but an obligation to perform, to deliver the product or services to be performed had not yet been done. Well, in this period, service was performed, and so revenue was earned and needs recognition. At the end of this period, we need to record an adjusting entry to adjust the revenue deferral. What was unearned before needs to be adjusted. A portion of it needs to be shown as earned. How do we do that entry? Unearned revenue account is debited. It is a liability account, and liability account increase on the credit side, decrease on the debit side. We want to show the decrease of this liability. Before, when it was established, it was a credit balance, an increase of this liability. Now that revenue has been earned, we need to show the decrease, therefore a debit to the unearned revenue account and a credit to revenue. Revenue account is credited to show the recognition of revenue. Initially, at an earlier point, there was an entry that established the unearned revenue account, a deferral of revenue. It was an obligation. Money was received, but services wasn't provided yet. So the balance was established as an unearned revenue. Again, a deferral. However, now in this period, at the end of the period, we need to make an adjusting entry to show the recognition of revenue. A portion, if not all, of what was unearned before is now earned. Therefore, the balance essentially is being transferred from unearned revenue account to revenue account. This entry is very important to complete at the end of the period because without this adjusting entry, liability is overstated and revenue is understated, impacting the bottom line of the financial statement. Another entry to record at the end of the period is the adjusting entry for deferral of expenses. For example, something like insurance, which is purchased in advance, such as a 12-month car insurance policy. It's recorded at the time of purchase as an insurance prepaid asset. Yes, it's an asset. Now, through the passage of time, a portion of prepaid asset is consumed or has been expired. At the end of the accounting period, the company must recognize the consumption of insurance through the passage of time and record expense incurred, or any expenses that are incurred as time passes. Think of subscriptions. It's prepaid, and then as time passes, it's being consumed. Another is prepaid rent. Rent is usually paid before occupying the space, or it's paid in advance for future months. As each month passes, the company needs to recognize the expense incurred, the rent expense. Therefore, the prepaid rent asset needs to be transferred over to the rent expense. This is done as an adjusting entry at the end of each period into the asset or expires. How is the adjusting entry recorded? Debit to expense account. Expense account increase on the debit side, and we want to show the expense balance is being incurred. Prepaid expense account is credited. It's an asset, and this asset is being used up. We had prepaid for it, and it's established as an asset balance. The asset balance is being used up. Some amounts is offset. It's being decreased. Therefore, a credit to the asset account, prepaid expense. And the expense account is being transferred, some portion of it, if not all, to the expense account. Think of expense account as supplies expense, insurance expense, rent expense. Prepaid expense account like rent prepaid, subscriptions prepaid, supplies prepaid expense account. Without this adjusted entry at the end of the period, assets will be overstated and expense will be understated. Therefore, it's very important to reflect this accurately on the financials.